Everyone, good morning. So today we are going to start with equity value. In the previous reading, we have discussed about enterprise value. So this is reading 2, episode 3. So let's get started. So what actually is an equity value? And in simple terms, equity value is the value of the company that is attributable to its shareholders, and it reflects what the company's owner or what the owners of the company actually own after accounting for all other obligations, and think of it as the market value of the owner's stake in the business. So that's equity value. So equity value, there are actually two meanings of equity value. So first is the market value, market equity value, which is also known as the market capitalization. And the formula for market capitalization is actually the share price into the number of shares outstanding. And the other formula for equity value, the other meaning of equity value is the book value of equity. The book equity value, which is the shareholders' equity on the balance sheet. And this is the accounting version found from the financial statements. And this the formula for equity value or the book equity value is simply the total assets, and we subtract the total liabilities, and this gives us total equity. All right. So this is the simple version, but this is only the meaning about which we are discussing, and the meaning of equity value. There are two meanings, and okay. So there is a so what is actually now the difference between equity value and the enterprise value? And at times, because the names are somewhat around similar, EV or versus EV, enterprise value versus equity value. These are two commonly confused. Equity value is actually the value of the shareholders portion only, and it represents ownership value. However, enterprise value is the value of the entire firm, including the debt, and this represents the value of operations. The relationship between enterprise value and equity value is here. Enterprise value is equal to equity value plus debt, and we subtract the cash. And equity value is calculated using this formula when we are discussing about enterprise value. So this is the market equity value and this is the equity value. There is a difference between equity value and the book equity value. When we are discussing about enterprise value, we are looking at the market equity value. Market equity value. And here in the formula, we have not considered the preference and the preference stock or preferred shares and the minority interest. So don't get confused. This is just a simpler version of enterprise value. How do we calculate that? That's how. And why equity value matters. Let's discuss about this thing. Why equity value matters for investors. This shows how the market thinks of the company's worth today. And for companies, this is used to evaluate merger acquisitions and financial health. And also, this is a part for valuation purposes. Equity value is used, and it's an important metric. Price to earnings is equity value about net income. This is an important metric when we are, this is an important metric used in valuations. Okay. So let's discuss. I hope this much is clear. This much is clear to you all guys. Equity value is simply there are two formulas. I mean, there are two meanings of equity value. And basically, first is the market equity value, and another is the book equity value. If you're looking at the market equity value, it means that you're looking at the share price and the number of shares outstanding. But when you're talking about the book equity value, you are looking basically at the shareholders' equity, and which is total assets minus total liabilities. And where did this formula come from? This is a common formula in accounting. Assets is equals to liabilities plus equity. And when to find the equity part, we just subtract assets minus liabilities is equal to equity. This part. And that if when we discuss about equity value versus enterprise value, so enterprise value is for the whole firm, and equity value is only a represents the ownership value for equity holders only. And the relationship in between equity value and enterprise value is this. Enterprise value is equal to equity value plus debt minus we have subtracted the cash component. And what does equity value means for investors is, for investors, it's simply what the company is worth today. For companies, it's used to evaluate merger acquisition and financial health. And for valuation purposes, price to earning ratio, these are important metrics and which are calculated using equity value to and net income. All right. So let's talk about equity value in a discounted cash flow. And when you talk about equity value in a discounted cash flow, so we are referring to unlevered DCF. Uh, Two types of values are there, unlevered and levered DCF. If you discount the free cash flow to the firm, the free cash flow to the firm, this is free cash flow to the firm is used to calculate enterprise value actually. Enterprise value. Let me just be a little clear so that in next meeting it's easier for you to connect. So you discount the cash flow available to all capital providers, which is debt plus equity and the preferred holders. This will result the enterprise value. And to get the enterprise value, you need to adjust the capital structure. So if I want to find the equity value, so I will simply reverse engineer the formula. So I will calculate equity value. I will calculate equity value. I will use equity enterprise value. I'll subtract the net debt and I will add back the non-operating assets. So in simply, I will subtract the debt and the preferred stock, and I will add back the cash and the other investments. I will add or I will adjust for minority interest and leases if treated separately. And this is the most common method in investment banking. This is the most common we use unlevered free cash flow. Just remember this free cash flow of the firm. We use this, and we then calculate the equity value. And to calculate the equity value, I adjust the enterprise value. But if you discount free cash flow to the equity, which is also known as levered DCF, so you discount the cash flow after debt payments, and this will result the equity value directly. And the formula for this is the summation of free cash flow to the for free cash flow to the equity, and we will discount all those free cash flows, and then we will add the terminal value. Then we will discount the terminal value to the current time period. Okay, if you okay, the discounting of a DCF looks like this, and from this period, I am talking about the terminal value, which is the value if the which is the rate at which the company is going to constantly grow forever. So what I need to do is this formula represents this part represent. I will actually have to forecast all those financials, and then I will forecast. Uh, this is FCFE1, F FCFE2, FCFE3, FCFE4, FCFE5. This formula represents I will discount everything to this time period. And the terminal value, this formula represents that the terminal value at this point will be forecasted back to here, and this will calculate the equity value directly. But usually this is not followed. We follow the free cash flow to the firm. This is followed in different scenarios. So this will be followed in case where there is only equity. We need to calculate the return on equity, not on DCA, not on debt. So this is used in case of leverage buyout majorly. I hope this is understood by you guys now. So this formula, this part represents that we are discounting everything back to the current time period. And here we are, the terminal value means that we are discounting the terminal value to the current period. Here, this amount, whatsoever would be this amount, we will discount it by 1. Discounting factor will be 1. The T time frame will be 1. So this will further on impact. And let's assume that the rate of equity is 10%. So I will be discounting FCFE 1 by 1.10 to the power 1. Similarly, I will discount this thing by 1.10 to the power 2. I will discount this thing 1.10 to the power 3, 1.10 to the power 4, 1.10, 1.10. Okay, and understood. 1.10 to the power 5, and this also I will discount it to the power of 1.10 to the power 5, and I will separately bring it to the recent times. This is how DCF is done. I hope this is clear to you guys. All right, so okay, let's move to the next part. So how equity value differs from market cap? And most people confuse actually equity value with market cap. The thing is that the market cap is just the value of common shares, and equity value is broader. So equity value is actually market cap and in the money options plus restricted stock options and the preferred stocks. And equity value include all equity claims, not just common stocks. Just remember this. Equity value is actually broader concept and it includes all equity claims, not just common stocks. And there is also a difference between equity value and the intrinsic value, where equity value and intrinsic value. So equity value is actually market driven or model driven value, but intrinsic value is actually the true value or the underlying worth of the company. And this is based on competitive advantage, moat, management quality, future cash flows, economic conditions, and the market, the equity value, which is the market driven or the model driven value. This represents what the market models says the shares are worth. And at times you will see that if you're calculating the intrinsic value of a stock, your after every calculation, you will not be able to match what the market is thinking about the value of the stock. So that's the market driven, the equity value of the market, market driven or the model driven value, and that's the calculated value. So this is dependent on the competitive advantages, moat, management quality, future cash flows, economic conditions, and these are dependent on the common shares, preferred equity options, and RSUs, restricted stock options. And equity value is a financial measure, not an opinion. So equity value is a financial measure, not an opinion. And uh, the other part and the intrinsic value is highly dependent on assumptions. And uh, this is used by Warren Buffett and the value investors. Just an FYI. And the key distinction here is that intrinsic value is more theoretical value, and equity value is a model or the market or model output value. So your DCF is actually an attempt to estimate intrinsic value, but the resulting number depends entirely on your assumption and discount rate, cash flow growth, terminal value, and multiples, etc. So just remember these pointers here: the competitive advantage, moat, management, the quality, future cash flow, economic conditions. These are the underlying factors for intrinsic value, and common shares, preferred equity options, RSUs. These are actually um, these are these actually are the factors which influence your market value of the stocks, equity value. Okay, and let's do a summary. So let's quickly just revise everything. So the concept is about equity value. Equity value, what it means is it's value attributable to the equity holders. It's used in valuation of merger and acquisitions. Market cap is the value of common shares only. So that's market cap, and it's the stock. It's used in stock market as a measure. Enterprise value is the value of the entire firm, which is a debt plus equity minus cash, and used for enterprise value, EBITDA, or enterprise value revenue multiples. Intrinsic value is the true value of the it's a true value based on fundamental, and it's used by value investors. However, equity value from DCF is a part of free cash flow to the equity DCF, or it's or driven derived from enterprise value and connects DCF to the shareholders value. Okay, so let's wrap this up today, the session here, and we will discuss the rest of the part in the next video, next episode. Thank you everyone for attending this lecture. Um,